full employment should be in quotes, but we are in a very close. If we're not now in a full employment economy, we're very, very close to it, in quotes, at least in terms of the official unemployment rate. Our themes is the economy is approaching full employment. We think we're going to get around 3% real growth next year. Wage gains will be 4%. Inflation is going to be over 2%. The Fed's going to tighten in a couple of weeks. The consumer, housing, commercial construction, and defense are going to be the leading sectors. And the big risk is exports get much weaker than what we have it. Now, our forecast, to put it in context with all the other forecasts that are out there, and there are a lot of them, is we are towards the top on real growth. So we're above consensus by more than a little bit. There are about 50 forecasters in the blue chip survey. We're in it. We rank number 5 out of 50 towards the top. So this is more bullish than you'd expect. We have more inflation than what most people have, because we think inflation will be higher than consensus. On unemployment rate, we're pretty close to consensus, to put all that into context. And on the Fed for 2016, we're pretty close to consensus. For 2017, we have higher rates than consensus, but that's a year and a half out there. So I would just put this in a framework as to where we are compared to the rest of the world in the markets. Well, this is the unemployment rate. Unemployment rate last month was 5%. We're going to get an employment report on Friday. Our guess is it'll go through 5% on Friday. Consensus is 5. We think it'll be 4.9 on Friday. And ADP, a private survey of employment, came out today. It was 217,000, which was above the Wall Street consensus. So far, so good. And we expect the unemployment rate to stay below 5%, get there through 2017. Now, this is the employment to population ratio, and you notice the collapse in 2009 during the recession, 2008, 2009. So there hasn't been a recovery here. So if we were really looking, if it was really full employment, this employment to population ratio, which is around 59% right now, it may not go back to the old high of 64% because of demographics, but maybe the number ought to be 60 or 61. Now, we have disagreements of what that equilibrium rate is within the project between me, Ed, and Jerry, but we all agree where it is right now is lower than what that equilibrium would be. It's just a question of how much lower it is. So even though the official unemployment rate is looking like full employment, there's still slack, in this sense, there's still slack in the labor force. But one measure, and this is growth in jobs will continue around 200,000 this year, a little bit less following year. Real GDP, we have it growing around 3% next year. Now, there's a couple of things. This forecast was done prior to the revision of GDP that came out the day before Thanksgiving, and we didn't rerun everything over Thanksgiving. Hopefully, you'll forgive us for that. Third quarter GDP was revised up from 1.5 to 2.1. A lot of it because there was less inventory. There was a bigger inventory build than what they previously thought. So our sense is we have 2.9 for the third quarter, for the fourth quarter right now. That's probably, if we had to do it today, would be 2.5, because we were going to get a rebound on this inventory thing. We're not going to get it in the fourth quarter. It'll probably be more in the first quarter. So even though there's a 2.9 here on the chart right now for the fourth quarter, probably 2.5 is probably closer to correct. Now, we have a big jump in Q1, and that big jump in Q1 has to do with a big increase in federal spending coming from the temporary end of the sequester. So federal spending is going to be ramping up by $80–90 billion on an annual rate, and we think that's going to hit. It's going to hit in the first quarter, then flatten out. So that's that big bulge in the first quarter, the 3.9, and then it sort of slows down a little bit. But that's what that is. In real life, the run rate will be around 3%. It's not going to be 3.9. Now, one of the signs of why we think we may be closer to full employment than employment population ratio would suggest is that we think wages are going to be going up. And the true test of a market is the market is tight, and if you're close to resources closely to be fully employed, you expect prices to go up, which in this case, wages to go up. Now, I want to throw a couple of things out. We had 5% annual increase in annual rate in the latest employment report. There's a 6% increase in total wages in the economy in the personal income data in October. And then the auto workers did contracts with General Motors and Ford in the past couple of weeks. And they did away with the two-tier wage system that's been in place since 2009 with all the bailout of the auto industry. And they did away with two-tier, which means going forward, all auto workers would get paid the same amount, where it used to be for the past 5 years, new auto workers would get paid, in round numbers, $12 an hour, and existing auto workers would get paid $24 an hour. Everything is going to converge at $24 an hour. In round numbers in the auto industry. And you see retail is it's hard to get people. There's a whole bunch of industries right now that are scrambling for people, and there aren't people available. So that tells us wages are going to go up. And we have them running at 4%. This is above consensus, but this is a sign that maybe this employment to population ratio at 58, 59 may be the closer to the right number and not the wrong number. So we'll see if we're right here or not. And Friday, it will see if we ratify the big increase last month in wages when we get the employment report. If you see a number over 0.2%, it's a sign we think we're moving in our direction. If it shows a 0 or there's a down revision, then it's a sign we're wrong. So that'll be all. You'll find out on Friday. Sometimes you can make a forecast. It takes a long time to figure out whether you're right or wrong. We're going to know on Friday. The other thing we have is in our forecast is we have oil prices bottoming around where they are now. Consensus would have oil prices going into the 30s, the WTI. We have them bottoming around the 41, 42 where they are now. The most important event this week is not the employment report. It's the OPEC meeting on Friday and Saturday. Now, most people expect nothing to happen at the meeting, and then you may open up a trapdoor with the price of oil when nothing happens. But 2 weeks ago, the Saudi foreign minister met with Putin in Moscow, ostensibly to talk about Syria. Last week, Putin was in Tehran having a meeting with the Grand Ayatollah Khamenei, ostensibly to talk about Syria. Russia and Saudi Arabia are the two biggest oil producers in the world, and the United States is roughly tied with them. Also, now, don't you think that they might have spent more than 2 minutes in conversation about the price of oil? So to me, is something may be happening there that's not in the market. And if something happens, is you will see something where OPEC will announce some modest production cuts, which is not in the market, and you'll have the implied consent of Russia. Now, maybe all this blew up and nothing is there, but this is out of consensus. Otherwise, is our bottom in oil prices, which is the current quarter, probably will go lower. We'll probably go in the 30s before we get an agreement. But basically, is Saudi Arabia can't take the pain because they'll have to break the dollar peg with the real. Russia can't take the pain where it is, especially they need $100 oil to make their budget work. And their budget is now higher because they're fighting a war in Syria that they didn't plan on fighting. And Saudi Arabia didn't plan on fighting a war in Yemen, and that's all very expensive, and their budget's under stress as well. So Friday, Saturday is the big deal with the OPEC meeting. I think probably will be more important than the employment report on Friday. All right, inflation. So inflation we think is on track to be 2+%. And people say, well, how do you get there? Well, you get there is that on a year-over-year basis, core inflation, which is CPI less food and energy, year-over-year is 1.9 right now. So all you got to do is say oil prices flatten out and go up a little bit, and food prices level off and go up a little bit, and you're over 2% real fast. So on service sector inflation is 2.8, 2.9 right now. So if you feel prices are going up more than 2%, your instinct is probably right if you back out gasoline and stuff on it. Now, California prices have dropped, but California gas prices are way above the national average by a lot. In New Mexico, I pay $1.85 for regular regular gas. In Oklahoma, I understand it's $1.75. National average is $2. So when you see $2.80 here, which looks low, it's like the highest in the country, probably, except maybe Hawaii or something like that. But we think inflation is on track to be over 2% next year. And that will lead us to the Fed beginning to raise interest rates, so we have the Fed acting in 2 weeks. They'll go from 0 to a quarter to a half. Now, our forecast compared to consensus is for 2016, we are pretty close to consensus. We have the Fed funds rate at the end of 2016 at 1.5%. Now, Goldman Sachs put out a forecast a few days ago. They have the Fed funds rate at the end of next year at 1.25%. So that's close enough for us. Where we're out of consensus is we have the rates going much higher in 2017. That's because we have the higher inflation. Now, if we're wrong on the inflation, we're going to be wrong on the higher Fed funds rate. So we're out of consensus, not so much for 16, but for 17 on these rates, okay, to put that in perspective. Now, what's going to drive the economy is we think the consumer is fine. We didn't get upset when Macy's reported bad results, Nordstrom's reported bad results, all the department stores reported bad results, because online did much better than retail, in the streets, so online retailing is working. And as far as we've heard from MasterCard and Visa and people like that, is they haven't really noticed any kind of slowdown in consumer spending. So as long as those people using credit cards, it may not be in department stores, it may not be in the malls, it's going to be with Amazon and other people and restaurants and things like that. So we think retail is fine. And the other thing that's really booming is car sales. And we're going to have this is the best car year since 2000, and next year will probably be a record year for car sales. We're at an 18.2 million run rate for the month of November, and our guess is that's going to continue for a couple of years because you have all those cars, if you take a look, that were sold between 1999 and 2005. They're all anywhere between 10 years and 15 years old, and they're going to go off the road, and you sort of see that. And there's a big replacement cycle that has to take place, and even though folks are going to use Uber and you're going to share cars and do all that other stuff, that's more something to worry about for 2020, 2021, 2022. But I think near-term car sales are probably going to hold up in this 18 million, plus or minus 18 million units. And it's just a touch above 15 years ago, so this is not heroic kind of a number. Housing starts, we think, are going to rebound. We talked about it last quarter, and we think multifamily will be exceptionally strong, and single family will begin to rebound. And we think housing can take at least the rise in rates that we foresee in 2016, 2017. We'll figure it out. That's why we have starts rolling over in 2017, because we think the higher rates will have some impact by then. Non-residential construction is flat in the near term, and then we expect a big increase. But there's two components that are going in different directions in non-residential construction. This is the spending on mining and wells, quote, oil rigs. So this has collapsed from round numbers 140 billion to 70 billion. On a pure arithmetic basis, is the collapse in oil capital spending will take 0.4% off GDP for this year. So if real GDP is going to come in at 2.5, on a pure arithmetic basis, it's 2.9. If you add that 0.4%, if you back out just this oil CapEx. So it's hurting with the parts of the country that were really booming 2-3 years ago, Texas, North Dakota, Oklahoma. They're in a world of hurt. Over here, we're just benefiting from the lower gas prices pretty much, and the world is pretty good. So that's been really whacked. It's been a real hit to GDP. There was a big article in the Wall Street Journal about the big drop in the slowdown in capital spending. It's coming from this sector, because this doesn't include a whole bunch of machinery. It doesn't include a whole bunch of other things that go into the oil business. It doesn't include all the rail cars that move the oil that aren't moving the oil anymore. So it's affected a lot more capital spending than just this item right here. The other part of non-residential construction we think is very strong. I think it's commercial construction. And you have the Alan Matkins report here, which talks about the outlook for construction in the major cities of California. And that's a very bullish report. So we think there's so much money going into commercial real estate right now. Whether the buildings are going to be needed or not, they're going to get built because capital wants to invest in real estate. We're going to find out if they build too much. By 2017, we'll know, but our sense is this is going to be a capital-driven boom in commercial and commercial construction, which will be reasonably strong. But it's still below 2007, And we have it peaking here at 145 billion, plus or minus. Back in 2000, which is not on the chart, this peaked at 190 billion. So we're way off from any kind of potential record. So we think this is also reasonable given the amount of capital that's flowing into that sector. All right, the risk here is exports, because the world economy isn't strong. In some places it's very weak. We have a very strong dollar, which is here, so which makes our exports much more expensive. So if we're going to be wrong, one of the places where we could really be wrong is, instead of having a plus sign on exports, we get a minus sign, and it gets much worse. And so if we have a big risk out there is sort of the global economy stays weaker longer, and the dollar is stronger than what we have it. And we have the dollar peaking pretty soon. And part of it is we think everybody knows Draghi's going to ease. Everybody knows we have all these interest rate differentials in place. So we think most of the move of the dollar is already in the price. That could be totally wrong. Of course, there's some forecasts that would have this chart at 120 out there that would have it go to 140 by 2017 out there. And we have it peaking pretty soon. So that's if we have one big risk, the thing we worry about most is exports, that our export industry totally collapses next year. That's a risk. And we have a modest gain. We could have a big loss. So that's the risk in the forecast. And the other thing that's changing, something we've talked about for the past 3 quarters, and we were just guessing, that the 5-year decline in real defense spending would be over. Well, Congress ending the temporary sequester, basically we're going to get an increase baked in the cake in 2016 for higher defense spending. So after 5 years of down, defense spending is going up. Now, the stock market has noticed this because all the defense stocks, related defense stocks, have been making new highs. So that spending is going to flow in. Now, 2017, there's no money. 2017 is not in the budget yet, but our guess is that if Hillary Clinton is elected president or one of the Republican nominees are elected president, except for maybe Jerry's candidate, Bernie Sanders, or something like that, is we're going to get higher defense spending no matter who wins the 2016 election. Defense spending is going to go up, and then they'll lift the sequester for 17, 18, and 19. And this could be a 5-year cycle on defense spending. And part of it is also you got geopolitical. This is just Putin in Syria, but we had Paris. We have there's all kinds of reasons why defense spending is. All you guys just pick up the paper, and defense spending is going to go up. There's more special op people in Syria and in Iraq right now. So the question is to us is, are we too low for 2017? Not that I don't think we're too high. I think if anything on 2017 defense spending. On our chart here, I think we're too low for 2017. Not that we're too high, because I wouldn't be surprised to see it at 4% in 2017. There, I think we're too low, but we'll see. Okay, so to conclude is, next year's going to be a good year. I think we're going to have rising employment, unemployment. We could see 4.6, 4.5, 4.7. We think wages are going to be growing around 4% on a year-over-year basis by the end of the year. We're going to have some modest inflation, and call it 2.5, and not the 0 or 1. The Fed's going to gradually increase interest rates initially, and if we're right, they'll speed it up in 2017. There's lots of strength in construction, and the downside risk is exports. So thank you.